Right, hello everybody. Welcome to today's podcast. So my name is Adrian Boothie. I'm the head of trading here at Trendsignal, and as ever, I'm joined by our managing director and chief analyst, Jerry Miller. Hi, Jerry.
Morning to you all. Morning, Adrian.
Good. So, well, look, it's Monday, the 9th of October. It's been quite a lot going on last week. Some interesting non-farm payroll data, which definitely sent some interesting moves in the markets, Jerry. So what we like to do is just start off these podcasts talking a bit about what's happened last week. So since our podcast last week, so what are the main headlines? What do we need to know?
Well, the main headline was a bit of a recovery in stocks, but you wouldn't have thought that the payroll data. So this is this non-farm payroll data, which is the employment data excluding the sort of farming sector, which is very seasonal, and it's something that the market hangs on every number basically that comes out because it influences what the Federal Reserve, that's the US central bank, do with interest rates. So it's basically employment data, to put it in a nutshell. And last week, this came out on Friday. So up until last Friday, the market had been struggling a bit, and I think it's rates are going to be higher for longer. Some of the data wasn't that great, and just generally the mood in the market was just one of sort of resignation to the fact that it's possible, it's still a bit of a close call, that rates may go up another notch before Christmas. Anyway, the release came out at 1:30 on Friday, and it provided a real sort of bout of volatility from what actually I thought, and everyone else thought, looked like a strong report. And I'll explain why. It's because the number of new jobs created in September, these are new jobs, was 336,000, which is way more than the 171 consensus, i.e. what the market was expecting. Not only that, the report also upgraded the number of jobs in August by 40,000. So it was way, way stronger than expected. So the initial market reaction is what you might expect. And what would we expect on a strong report? Something that may well sort of force the Fed's hand to raise rates more, i.e. the economy doing better than expected. And yes, the payroll data suggested that. So the initial reaction, basically the equities sunk and they fell quite hard, basically in reaction to the likelihood of another rate rise this year. But 2 hours after the event, roughly at about 3:30 on Friday afternoon, I think a lot of analysts and economists had got together and they concluded the job data actually contained quite a lot of positive elements that painted a less inflationary picture. And you think, really? It was just a little bit confusing. Anyway, whether the data on its own is strong enough to weigh on the Fed's thinking remains to be seen. Whether this rate rise still a close call. But just so we understand this, the labour market remains strong. But I think what was key was this drop in something called average earnings, Adrian. So it was 4.3%, it's 4.2%. You might think, oh, Jerry, that's so minuscule. But it's important that everything hinges on inflation and unemployment, or the employment data. And if people are earning less, it's a lot less inflationary.
Absolutely.
We have a lot.
So it's the case. There's lots of new jobs being created, which is like the first thing everybody looks at, and then all of a sudden, but on the other hand, actually, it doesn't seem to be creating an inflation problem. So maybe it's okay. So hence the sort of the rally that we saw, because average hourly earnings were below expectations, weren't they? Which sort of seems at odds with the data, doesn't it?
Yeah, but what seems even weirder was that the unemployment rate remained at 3.8%. And I hear you saying, well, hang on a second, Jerry, we had 336,000 new jobs and apparently another 40,000 created in August that we didn't know about. Yes, but the actual number of people looking for work who were economically active increased. And that's a sort of a positive sign for the jobs market. And I think what the conclusion that economists had was that it looks as if the jobs market is going to have a sort of a bit of a soft landing, i.e. if there is going to be a slowdown in economic activity because of the Fed rate rises over the last 18 months, then the jobs market is not going to crater. and it's something that will not force the Fed's hand on its own. And anyway, as a result, equities really rallied hard to the close, and the NASDAQ, having been down after the number, ended up 1.6% higher. Just a stonking performance.
Yeah, I mean, you can see the big drop. I've got them on my screen here. So from 130 on the announcement, the Dow, this is, suddenly we fell, I don't know, 300 points or so. And yeah, the big rally, still a little bit indifferent, but it really wasn't sort of, as you say, 2 hours later at about 3:30 when suddenly it just kind of went for it, didn't it? Fascinating.
Yeah,
really.
but it just goes to show you when, someone has got the balls enough to sort of push the market higher on what looked like a pretty negative report. And by the close, the S&P, although not like the NASDAQ, but the S&P was up 1.2%. And believe it or not, the 1.2% rise in the S&P was the best performance for 5 weeks. So it was an extraordinary outcome, really, Adrian.
Yeah, and there was that similar move really with the dollar, isn't it? Again, you'd probably expect that, you'd expect the dollar to rise a little bit, but really you look at what happened on some of the currencies, and again, it was kind of more back the other way once it realized what was going on. So, okay, what about what's going on with Hamas in the Gaza and Israel? Do you want to tell us how that might affect? Obviously, a lot going on there. Tell us about how that might impact the markets.
Yeah, I mean, it's pretty shocking news. But just to recap, over the weekend, Hamas, which is classified as a terrorist organization, they're based in Gaza, attacked Israel, which resulted in a big loss of life on both sides, but certainly on the Israeli side. I think they've lost over 700 souls, unfortunately. And I think the immediate concern, I mean, obviously, aside from the dead and injured, which is pretty horrendous, is an escalation in this conflict where Hezbollah, which are sort of based in southern Lebanon, and they're funded by Iran, if they get involved, that would have a lot bigger implications for the markets. Now, obviously, the main beneficiary of this was oil. Oil, as if you want to put it up on the screen, you can see it actually jumped 5%, but actually it had fallen. It had slumped last week, Adrian. It had fallen about 9%. And oil is a very strange market. Everyone was talking about $100 only a week ago, and all of a sudden now we were down at $83. I mean, we've rebounded about 3.5% so far on Monday. But where it goes from here, it's not clear. It depends whether this unrest, this war that Benjamin Netanyahu has declared on Hamas, it looks like they're going to probably invade Gaza and root out all Hamas once and for all. But it is a destabilizing influence. Now, obviously, Palestine and Israel don't produce any oil. That's not the point. The fact is, it could destabilize and influence the Middle East, which could obviously affect oil production and supplies. I mean, already there's talk that Iran sanctions could be enforced more rigorously in the wake of this, which could affect this deal that the US is trying to broker with Saudi in accepting Israel politically. Anyway, the jump in oil, as you can see on the charts, has happened. Whether it rebounds further really depends on whether the conflict escalates or not.
So, do you think, as traders, should we be steering clear of oil right now because of fear of some sort of shock announcement, which could really just ping the oil price in one particular direction, or what would your sort of recommendation be here?
My recommendation would be to wait until the US comes in, because that'll be the real driver, and that's what caused oil to really slump last week when US traders came in, and that big candle that you can see on the chart on Wednesday. I mean, that was a huge fall.
Really
that was one of the biggest falls for 15 months in crude oil. I think it was about 5%, something like that on the day. Yeah, the biggest fall since August 22. And it was a big move, 9% lower on the week. So when you see this sort of rebound, it's sort of recovered Friday's sell-off and a little bit of Thursday's sell-off and a little bit of Wednesday's, but it's still down from where it was a week ago. it's difficult to know. It's difficult to know what's going to happen, but it really depends on this conflict now.
I do think certainly for sort of more risk averse traders, swing traders in particular, just be a little bit mindful because the market could be jumping up and down based on sort of any news that really comes out. So what it basically means is that the market might start to behave in a slightly more abnormal way. So sort of better to trade it when it's more normal behavior, really. Day traders might find it a bit more interesting because there's going to be a lot going on that you can respond to more quickly.
Yeah,
but swing traders, day traders.
That's easy. I mean, we've taken our profits on our short trade, and that was a pretty decent one. A lot of our customers actually, from what I understand, did actually stay in that trade. So there were quite a lot of riches to be had there. Now, again, just to reiterate that, I wouldn't be rushing in to establish any, not that there's anything signaled at the moment, but I wouldn't be rushing into any trade just at the moment. As you said, intraday trading is the way to go because that is something you can control from 1 minute to the next.
So you said, thank you, Joe, and you said earlier that probably wait until the US traders come in. Now it is Columbus Day in the States today, so but then not all markets are closed. So are you saying we should really get some guidance that it's going to be today, or is it more likely to be waiting for tomorrow to see what the impact's going to be from a US perspective? I mean.
No, all the markets are open, actually. So all of the Chicago Mercantile Exchange holiday schedule does not include Columbus Day as a holiday, and same thing with the New York Stock Exchange. So it's literally a bank holiday, which affects the bond markets more than anything else. Otherwise, our markets or the markets that we trade are all open. So, but I just would wait to see what the influence will be from US traders because they were the ones that pushed oil a lot lower last week with hedge funds just capitulating, which did cause that big slump on Wednesday. So I'd like to see what they're going to do.
Okay, excellent. Any other sort of main things to cover off on perhaps looking at the currencies, maybe looking at gold there, Jerry, or should we move on to this in the coming week?
We can move on, but gold has typically reacted to this global macro event in Israel. So we're up, what, $20 and counting, which is sort of what you'd expect, really. If anything, I'd have expected more, but there's a bit of profit taking from people who had actually shorted the market over the last 2.5 weeks. So yeah, it's a typical reaction when you get a global macro event that destabilizes the market. You typically get a flight to quality, and people put their money into something that typically does well when there's instability, which is gold and also the dollar. You mentioned that earlier on.
So looking at gold is really interesting around here. It's that sort of 18-14 level. We sort of hit these zones around February, March earlier this year. And we're back to those levels now, that 18-14 level. We sort of spiked down there. It's just sort of spiking through those green dots and struggling to stay below it. So that's what we're seeing, and that's a bit of a contra trend buying opportunity that's setting up for later today. Now, normally contra trend against the longer term trend direction, against those arrows on the left side of the chart, makes it a little bit higher risk, but often gold will overshoot a little bit more, so there can often be some decent value. But from this individual context here, nicely bouncing off that support from earlier this year, a support level that actually then generates a significant move higher. It's a pretty interesting zone. We'll be looking at this very closely tonight for our trading. Okay, excellent. So let's have a quick look at what we don't know yet. So Jerry, can you take us through, 2 or 3 of the main events for this coming week that traders need to be, rather mindful of?
Yeah, I think let's get straight to it. It's all to do with the Federal Reserve and what will influence them in their decisions, and also the Federal Reserve actually reporting on, how they deliberated the recent decision to keep interest rates unchanged.
So that's 7 p.m. UK time Wednesday, right?
Yeah, so it's called the FOMC meeting minutes. Unlike the Bank of England and other central banks that publish their minutes in the same day as they publish their decision on their interest rate moves. But for some reason, we wait 2 weeks for the Federal Reserve to come up with theirs. And it can give us a few clues about the likelihood or perhaps the likelihood of no rate rise, but something. It'll give us any clue as to what is going to happen before the year end. And the markets love all that, and any extra bit of information they can get. So you'll find that the dollar and US assets will be particularly sensitive to that, Adrian.
Absolutely. And then we've also got some inflationary data, haven't we? So we've got the core CPI 130 on Thursday too. That's going to be pretty big number, right?
I'd say that's the most important release of the week, actually. US CPI data. Now, it's not the most preferred one from the Federal Reserve. They love looking at the PCE data, the personal consumption expenditure data, which was a little bit stronger than expected previously. But so what we're expecting here is core inflation to be up 0.3%, which gives us an annualized reading of 4.1%. Unfortunately, it's not shown on this particular calendar, but that's what we're expecting. And the headline rate, which is the one that includes the energy and food data, that's the one that caused the big spike in inflation in the first place, that's expected to be up plus 0.3% as well, giving us an annualized rate, and it does publish the annualized rate here at 3.6%. So core higher than the headline at the moment, and it just really depends how high or not core inflation goes. The Federal Reserve is very mindful of the base effect. This is the fact that inflation had started to fall this time last year and was still falling, and so it's difficult to make that final push to 2%, which is the Fed's preferred target for inflation. Whether they believe that inflation is under control will depend on what these numbers say, and it will influence very much what happens with interest rates by year end, which of course, as we know, will impact the dollar, will impact bond borrowing levels, interest rates, etc., etc. So it has an impact across the board.
Yeah, so I mean, this item of data here, 1:30 Thursday, is going to have quite a pretty reasonable influence on the next interest rate announcements in the States, which is the 1st of November. Which, further to your comments about non-farm employment change, is actually now more likely to keep rates on hold than it was a week ago. So it's really interesting. And then similarly for 13th
which
of
is
December.
down to the that sort of what turned out to be a dovish view of the non-farm payroll data. What I mean by dovish, it means that it's less likely to result in an interest rate rise. So as you quite rightly pointed out, the probability of rates staying on hold has jumped actually. So it's close to 79%, and it was sort of 72% and 53% a month ago.
Yeah, absolutely. Good. All right then, Jerry. That's excellent. I think we'll leave that there. But thank you. As ever, everybody, just be aware of those major economic data announcements. There are a couple there. They're likely to cause some ripples in the markets. So, as a day trader, recommendation is always to be managing your risk effectively. So closing trades out ahead of major data is a good thing. Swing traders, we have to be a little bit more sort of careful with that, otherwise you'll never hold positions for very long. So that's not such a big problem. Actual interest rate announcements, non-farm employment change, those are the major items really for swing trading, end of day trading, position trading, however you might want to call it. Intraday traders, 7 p.m. Wednesday, 1:30 Thursday. Those are the most important items, and a few other things to be aware of as well. Otherwise, we wish you every success with your trading this week, and hopefully we'll see you again next time. So bye-bye for now.